Today, welcome. I'm Charlie Corbett. I'm the editorial director at Euromoney Conferences. Our chosen specialised subject this morning is covered bonds. Is it the calm before the storm? There have been murmurings for quite some time now that the covered bond market has become smug, that it is resting on the laurels it won during the financial crisis, and that if it's not careful, this creeping complacency could ultimately lead to unforeseen losses, or worse, irrelevance. But what are the central causes of concern? We're going to talk about these with our panel today. In particular, threats caused by a rising rate cycle and how this will affect bondholders and banks. What will happen if the longest bond rally since, according to the Bank of England, 1558 comes to an end? What are the impacts of new issuers, new structures, new rules? The popularity of the asset class might have soared, but can the covered bond club keep its reputation for quality? And heaven forbid, could one of these new emerging issuers end up defaulting one day? Finally, perhaps most worryingly, can covered bonds stay relevant in the face of new alternatives that essentially do the same thing and with the same safeguards, but are cheaper and easier for banks to issue? Now, that's enough from me. Before I ask the panel to introduce themselves, we've got a poll question. So if you look at your app, there will be a poll question on there. It may come up on the screen behind me, it may not. What is the biggest threat to the covered bond market? Rising rate cycle, issuer defaults, over-regulation, early and arbitrary regulatory intervention via the Recovery and Resolution Directive, or irrelevance in the face of alternatives. Also, with our wonderful new technology, you have the ability to ask a question via the app. So if you go into this panel, there will be a way to ask a question, and then I will get these questions in theory on this iPad here. That's the theory. Right, time to meet our panel. And I'm going to ask them now quickly to introduce themselves, starting on my right.
Sure. I'm Christina Costa. I'm in charge of covered bond research at Société Générale, and I'm also a member of the ECBC steering committee.
Boudewijn Dierik, covered bond and ABS structuring at BNP Paribas in London, also part of the ECBC steering committee.
Good morning. I am Paul Dudouis from CFF in Paris. We are an issuer of covered bonds, and I am running the long-term funding at CFF for a couple of years.
My name is Florian Eichert. I had the SSA and covered bond research at Crédit Agricole, CIB, and I tend to be involved in the ECBC activity as well.
My name is Maureen Schuller. I'm heading the financials research at ING in Amsterdam, the Netherlands.
Morning, I'm Jane Soldera, and I'm a member of the team that rates covered bonds at Moody's.
Thanks, guys. Right, well, let's start a little bit broad, I think. It's supposed to be a macro panel, so I want to talk, and it's been mentioned by all our previous speakers, obviously, but it'd be good to get your thoughts. The ECB's purchase programme. My first question is while it's been running, how has it changed the way that you've done business? And secondly, obviously, what difference is it going to make as it's wound down? Christina, if I start with you.
Sure. Well, when it comes to covered bonds, it has had a very big impact. The ECB has already holds almost 230 billion worth of covered bonds under its third purchase program. It's true that. And this is since it's 3 years running now. The monthly pace of purchases have gone down from 12-13 billion a month down to between 2 and 3 billion currently. But it currently holds around 40% of the Euro benchmark covered bond outstanding. So it's the biggest player in the market, the elephant in the room. And this has had large consequences. It has squeezed out a lot of real money investors. It has distorted the market because we have spreads at overall tights. There's little differentiation between jurisdictions. We have cases where Spanish covered bonds are trading even at the same level or even tighter than French covered bonds, so not necessarily reflecting credit risks. We have a case of really lowering of liquidity. If our trader were to be up here today, one of our covered bond traders, she would paint it a bit of a bleak picture. Pre-purchase program, the average ticket size in a covered bond would be maybe 20 to 50 million. Today, if she's lucky, it's 5 million, sometimes even 2 million. So it takes much longer to unwind a position. And it's very expensive to find paper. Now, this is all a big picture. We think this is temporary, even though the ECB is going to take, we think, a long time to exit the market, be it as we heard Jean-François Robin, the different scenarios, but since they will be reinvesting the proceeds, they will still be there. So they will still be in here. But still, we think that once the ECB announces tapering and slows the pace of purchase, we will have a bit of a more normalization in terms of spreads moves. We think that spreads will move forward, making the relative value a bit more attractive. And as for liquidity, this will also improve, but also the element that's missing is supply. So it's not just the ECB, it's banks which are awash of liquidity and have many different funding options. They will maybe want to tap the covered bond markets. But we are quite positive that in the long run, we'll get to. Yeah.
Barbara, so we've got squeezed out real money, ticket sizes falling, less liquidity, more expensive. That's what the purchase program's done. Would you agree?
Yeah, to most of it, yes.
To most of it.
In that sense, I think another point is that you could say, well, is it really temporary? Because the purchase program is in place for a while now, and the ECB has bought bonds which are with maturity up to 10 years, which they'll keep. So in that sense, you can say even if they start buying less and then just refinance, it will still have a long-term impact.
So let's compare it to a super tanker turning around.
Almost, yeah. I think the biggest impact is indeed on the trading side, because there's for them less liquidity. So for our traders, is less volatility means less interest for them, more difficult markets. And indeed, in terms of the spread tightening in general, you could say that certain credit items or certain features of cover bonds are less pronounced now, because it's so important to be part of ECB repo eligibility, purchase program eligibility in terms of pricing compared to other factors. Yeah. So that will change over time. I think that will come back a bit.
Okay, thank you, Ben. So, Paul, you're responsible for an annual funding program of 6 billion a year. So obviously, you will have something to say, I would imagine, about this.
Yes, from an issuer perspective, of course, this policy was quite helpful. We had a very strong compression in terms of spread. So we reached a very aggressive level of funding. That's the first point. And through this QE, we should reinforce the discussion with the investors, because of course the ECB put pressure as a big investor on the market. So we need to reinforce the marketing, we need to reinforce the dialogue and the transparency with our historical investor base to keep them on board. And since September 2014, in fact, we see new investor coming in our transaction. And for example, we did a transaction 10 days ago, 1.25 billion, 7 years. And in terms of book, if we compare the book, it's roughly the same structure as 2006. So that means that from an issue point of view, we are preparing, of course, the tapering, and in terms of execution, in terms of level, we see a very positive impact on our funding. That's for sure. The main constraint that we've got right now is the pricing discovery when we launch a transaction. With the pressure of the ECB, the secondary level on our bonds are not, reflecting the primary market. So we've got this pricing discovery when we launch transaction, and that means that we need to keep the dialogue with the ECB, of course, to make them happy because they are a big buyer, and also to our historical investor to keep them on board. Yeah.
Okay, thank you, Paul. Moving on to you, Florian. Yes, what are your views? And you are an active member of the working group of European Covered Bond Council, so
one part of the steering committee and
part of the steering committee.
State and statistics. As I said, I tend to be involved here and there.
Yeah.
I mean, as far as the ECB goes, I have to be thankful to them, because for once I actually get to see the touristy sites of some of the cities that I go to have meetings in, because I just tend to have less meetings than I used to in the past. So that's nice. Slightly annoyingly, I have to sort of publish something every Monday based on the numbers that they come out with, which is a relatively technical exercise because they don't really change all that much. But still, some people like to see and like to have the underlying figures. So good and bad.
Yes,
in terms of pretty bad at this point, I would tend to say they have bought so much, and that's sort of taken slightly away from the actual purchase program. They have bought so much that some of the measures that are announced or taken or thought about by the ECB's risk department are sort of moving in a direction that are quite hurtful to the markets. You could say they are buying loads of stuff, then they're getting cold feet, and then they're sort of implementing things that are in the long run quite negative, or could be quite negative.
So can't make up their minds.
So it's a bit of that, yes.
A bit of that, which is damaging. I mean, that creates uncertainty.
In the long run, yes, it could be. I mean, I'm sure that there'll be other panels talking about it, and we might talk about it as well at some point. But there are a few
Right.
things from sort of taking out sort of run-off entities from liquidity access to the ECB that are not so nice, and you could make the case are a result of them having bought as much as they have.
So they've reached capacity in terms of what they can buy anyway, haven't they?
Well, not that. That I wouldn't say. I mean, they have purchased some bonds in the primary market already up to 55-60%. So yes, you could say they're at the limit of that. But
so what should they be? So what, in your opinion, should they be doing? What should the strategy be from the ECB?
Well, I mean, to be honest, if you ask me, I mean, the sooner they're out, the better. But the sooner they're out, the better. But that's
it
not.
Distorts it, and it's.
But that's not going to happen. I'm just saying you shouldn't, because on the one end you've bought as much as you have, then start taking actions that you could make the point are motivated by the amount you already hold, that are then detrimental in the long run, because that could create the odd problem. And we've talked about the sort of role that the products played during the crisis.
Yes, exactly.
Well, it's also played the role it has because of the parameters that surround it. And if you start changing some.
Okay, well, Maureen, what are your thoughts on that? And I'd like to move on slightly to this sort of rising rate cycle and the impact of that. So all ECB policy still, but what are your thoughts? How would you react to some of the things Florian said, for example?
Yeah, well, in my view, if you look at the way how the purchase program changed things, I think you have to distinguish several stages, because in the beginning, obviously, when the ECB came with the announcement to start buying covered bonds, I think there were investors also enthusiastic at that moment in buying maybe into covered bond products that they would otherwise feel less comfortable with, because they knew there is now this investor that will buy it in a secondary market. Now, at some stage, we came to a point that spreads simply became too tight, and a lot of investors moved away from the covered bond product, as Florian already indicated, by means of the one-on-one meetings you have with investors, because the group of investors that looks at the covered bond product has simply become smaller. Christina already highlighted that has, to a certain extent, also come at the expense of liquidity, and I would also want to add, I think that at some point the ECB even caused erratic movements in terms of liquidity, because if you have episodes of huge primary activity, the ECB was actually quite active in the primary market, and assuring less liquidity in the secondary market at that stage, while when primary market activity fell away, they had to move or had to become more active again in the secondary market. But aside from the purchase program, I think you also have to discuss the period of negative interest rates. I mean, where investors before were looking at risk rewards when they bought covered bonds, the argument no longer was, I think, that bank or that product is fundamentally attractive and attractively priced. No, the argument at some point became, okay, that bond is offering a positive asset swap spread, it's offering a positive yield, it's offering a pickup versus government bonds, or it's still offering some pickup versus the negative deposit rate. So it became less
the question of which bond product is actually essentially attractive from a fundamental perspective. Is this going to be temporary? Yeah, but it's going to be a long period. Now you're talking for the
super tanker around.
Yeah, because I think where we are moving to is just simply the situation where the ECB is going to taper its purchases, and that is going to be a gradual process. Is it going to have a lot of market impact? Is it going to assure the return of a lot of investors? I don't think so, because I think in terms of yield movements, spread movements, not an awful lot is going to happen during the tapering stage itself. Once the tapering is done, the market will start anticipating a rising yield environment and tightening, a monetary tightening environment. And that will be the moment that you will see spreads move out more significantly, yields move out more significantly, and see investors return.
So Jane, do you agree with that? So the purchase program has been the right thing to do, and when do you think, when's that point at which spreads do start to widen, do you think?
With the purchase program, it is worth remembering back to the first purchase program that took place at a time when the markets had been under an awful lot of stress immediately after the financial crisis. And just when that was announced and what that achieved in terms of, I think it was 60 billion, I think that was something that was quite welcomed by the market at the time, and almost quite fundamentally changed some perceptions about how the ECB and its fellow regulators actually perceived covered bonds. It was a real vote of confidence in covered bonds, like officially as opposed to just kind of unofficially in the past. We've come a long way since then, but the purchase program, really, I mean, one of the biggest ways that it's changed thinking in a way is not so much in its immediate and its most recent impacts, but in the very fact that it happened in the first place. It has happened, and it could happen again. And the reason it could happen again is because of the way covered bonds are perceived as strong, safe instruments. So I think that's kind of worth bearing in mind, and it's you can feel the pain in the market that's been caused by the latest one because it's been driven by monetary policy considerations. But when all the fallout is done, it is still a big vote of confidence, and as well, despite what Florian said about some of the unfortunate side effects in terms of having one big investor kind of laying down a lot of new rules and so on.
Thanks, Jane. I want to talk a little bit quickly now about the rising rate cycle. Are we in a rising rate cycle, and if so, what will the impact be? I know covered bonds, my knowledge of covered bond isn't obviously as big as yours, but they're higher duration. So a rising rate cycle, what is that going to mean? Christina, what's that going to mean for investors in covered bonds?
Well, I mean, I think when it comes to the ECB, I think they're going to take very baby steps.
Tiny little incremental, easily reversible steps.
So it's going to be a slow normalization. So I don't see that we'll have a huge impact, and spreads will be able to adjust. As to house prices, now when I speak to investors across, I mean, yes, it's true that spreads are very tight, not reflecting fundamentals, but many investors that I speak to are still aware of the potential risks that could lie ahead. Some of those are house price appreciation, strong house price appreciations in some jurisdictions. Some jurisdictions with mainly variable rates, floating rates, and so they are cognitive of the fact. And so when you look at investors, yes, they need to buy because they have mandates, but I don't see them blindly investing in very long-term covered bonds. I mean, at the moment when I speak to investors, they're a bit on a wait and see. If you come from a 5-7, we've seen also some 10-year, but going much beyond without really knowing what's going to happen in terms of rate hikes in geopolitics. I mean, we haven't really talked about this, but a little bit.
Well, exactly, but it is what Stuart says. We're now moving into a recovery position, and so rates are inevitably, we are moving slowly. Are we moving slowly towards a sort of uplift in rates? This cycle is going to continue, or will there be a shock and we all go back into our
I think that's it, and that's why probably investors wait, because if you buy just before the rates increase, then with the current low rate environment, a small increase relatively is still big, going from let's say 0.75% to 1%.
Well, it all depends where you start.
Yeah,
I mean,
indeed, we start from very very low levels.
Zero,
So even baby steps can in that sense on a long duration bond have an impact. And you could almost say it's the same on mortgage origination. Mortgage loans mortgage loans the spreads even for consumers in some countries are so low. The absolute rates are so low that even a small increase will have an impact.
Yeah, but actually, Paul, well, let's ask you now. You know, it's your business, and house prices are fundamental to covered bonds.
As Christina and Bodywin mentioned, of course, it will have an impact directly on the real estate market, and it will have also an impact in terms of structural funding. Right now, we see less appetite for private placement in this low rate environment, and investors prefer to be on benchmark. On the medium part of the curve, that's been 5 to 7 years. So in this process, we will see more appetite once again on the private placement format. And I think from an investor point of view, of course, it will have a direct impact, and they will look cover bonds in a better eyes than right now. As you know, many investors, they have to move to lowest rating to have some yield, but they are in this position right now to mitigate this investment to single A, and they have to buy some AAA right now. So I think if we see some improvement in terms of rate, it will be better for cover bonds, for this AAA asset class, and for the structure of the product that we are able to deal with the investors.
Thank you, Paul.
I was just going to add to that. I mean, on the investor side, yes, everyone is sort of at some point expecting higher rates, and if you buy into 10-year now, well, chances are they'll be higher by the end of that.
Right, yeah.
But at the same time, the moment you move towards 12, 15 odd years, we've had really, really successful deals so far this year. Maybe not so much in terms of volumes and private placement markets, but in the public benchmark space, I mean, out of the Netherlands, ABN or my own company, I mean, we've done really, really successful long-rated, long deals, which might be a bit counterintuitive, but at that point, you're talking about slightly steeper spread curves as well, and about rates that, despite being overall low, are still high enough to sort of meet some of the requirements.
So that's what
that the insurance guys have. Where you do feel a bit of a hesitation on the investor side is amongst bank treasuries, amongst asset managers that have been filled up with 10-year deals last year, where if you come with another 10, they'll probably go like, no. Again. Now we've had 1 or 2 successful ones the past few days and weeks, but that was more an issue of there's just been so little supply that no matter what came to market, it was absorbed more.
They were going to absorb it.
But there you do see that element. I did look in the past that, and we've had instances when bond yields went from virtually 0 to 1% in no time. Covered bond spreads during those periods actually did nothing. And in the long run, I agree with Paul. If you have an absolute higher level of yield, people that were forced into taking risk will move back because they'll have certain thresholds of return that they want, and they obviously will try to minimize risk to get there. And at the moment, they just can't with sort of a product such as covereds going forward. They might again. And then, yes, you have some impact on some housing markets that are mostly floating rate based. And that does become more an issue these days on the investors' minds. And that's why we've had some sectors underperforming covered space by marginal number of basis points only, but still. But again, you have many areas that are long-dated, fixed-rate sort of mortgages. So, an increasing interest rate cycle is going to feed through to the underlying mortgage pools over a very, very long period of time.
Yeah. But more, do you agree with that? That an increasing rate cycle will feed through over a long
Yeah, because I think if you look at the current low interest rate environment, then yeah, it's true. It has fueled house prices. It has led to a rise of household indebtedness, and it has, in some markets, maybe made the market more vulnerable to a rise in interest rates because of the higher household indebtedness levels.
Course, yeah.
But as discussed earlier by these panelists, the rise in interest rates is going to be probably quite a moderated one. And you have also you must also be aware that I think that in different jurisdictions, regulators have really been on top of these housing market developments and have tried to cool down these housing price developments, either by lowering LTVs or providing incentives to amortize mortgage loans, or via risk weights on mortgages. So I think that the ultimate impact in the coming years of the rising yield environment on the housing market will remain contained.
Okay, thank you. Jane, a question in terms of this rising rate cycle. Are some markets more at risk than other markets, maybe, for a rising rate cycle? Is there any markets that stand out that might be more at risk with rates doing that? Or that?
From a credit perspective, that's probably not such a major issue. I mean, well, so whether you're talking about the bonds or the housing market, I guess.
Bit of both, actually.
For the housing market, yes.
The housing market,
okay.
yes.
For the housing market, yeah, absolutely. I mean, you know, the markets where you have a much greater proportion of floating rate mortgages are clearly going to be more exposed to a more of a shock as the banks feed through their funding costs to the market. What that will do is change the affordability equation. Now it's small on the interest side, big on the principal side. So you increase it on the interest side, then it starts to shrink on the principal side, which leads to downward pressure on housing values, and inevitably you get downward pressure or upward pressure on LTVs. LTV rises are a major default risk driver of credit risk on housing. So both on the default side and on the loss side, and that would, from our perspective, then feed through to the credit risk on the covered bonds.
Okay.
So definitely more on the housing side than on the bond side.
Than on the bond side. Well, then that moves me on to this question, which I'll throw open to the panel, which is, are we in a collective denial about credit risks in the covered bond market?
Well, you could say so, but on the other hand, if spreads are so tight and the differences between different programs, as Paul mentioned earlier, if the spread difference between one bond or the other is so small, you can say, well, I prefer to buy one or the other, but there's so little difference that you either say, well, I don't like it and I don't buy, or you sort of go with the flow, you accept it, you stay in the market, because at some point, I think also for investors, they can say, well, I expect rates to rise, but how long are you waiting for that? And in the meantime, you have maybe a negative carry for a year or two, right? So
yeah, Paul, you're nodding.
I think maybe
yeah, agreement. We all sort of generally of that view on the credit risk side. Well, let's. I might actually see if we've got any results from our poll. Actually, are we able to put the poll results up now? And don't be afraid to ask questions via the app as well, I would say. So what have we got here? The biggest threat is the rising rate cycle. We've got 11% issuer defaults. Interesting. Over-regulation. Well, let's talk about that. Let's talk about the covered bond directive. Let's talk about, obviously, is the covered bond market smug? It performed very, very well during the financial crisis. Along comes the Commission and says, right, we need a directive. So I might ask, why do we need this directive? If it's not broken, why are we fixing it? Maybe who would like to answer that? Christina, if it's not broken, why are we fixing it?
I mean, I think this is a push from maybe the regulators, and the authorities, the Commission, the ECB, as Florian was saying, it holds a large chunk of the covered bond market. Natlis has bought. I think they want to just make sure, tighten the rules, just so that maybe going forward, new structures, new issuers, new collaterals aren't just invented and piggyback on the covered bond label. So I think what they want to do is just make sure that the preferential treatment that covered bonds are awarded today will continue in the future, and that the high quality standards will continue. Now, that being said, so it's in a way it's positive if, as we heard Mr. Miliro from the Commission who said earlier, it looks like they are trying to opt for a more principles-based approach, and this is what the industry and the ECBC have been lobbying, are working towards. Because it's important that they have some overarching principles, be it in terms of dual recourse, segregation of assets, preferential treatment, definition of the type of assets, to make sure that that investors aren't confused that when they are buying a covered bond that you can't have, I don't know, in the future, credit card receivables in a covered bond. But it is important that they don't impinge on the national specificities of the market. Now, what will be, what positives I see of a sort of principle-based harmonization is when we look at further abroad in terms of looking to the future, in terms of new markets, new countries trying to tap this, trying to adopt legislation to tap this long-term funding source, it probably will help them in giving them some necessary steps to establish the necessary pillars for their legislation. So we've had Brazil, I think, that signed secondary regulation about 2 weeks ago. There are other countries in the Central Eastern European countries, as probably Richard Kemish is aware, that are looking at that. And they probably would, in order to benefit from advantageous regulatory treatment or from the large investor base, they probably want to make sure that, all the tick boxes are ticked. But again, principle-based harmonization.
Principle-based, so there's no one-size-fits-all. But it's a good idea, everyone agrees, to regulate. Florian?
I was just going to really quickly come back to why are they doing it in the first place. You could say, I'm not saying, but you could say they need something to show with the Capital Markets Union, and CAVIT is quite an easy one to sort of ticked off the box.
So this now drives into the Capital Markets Union?
It is part of the Capital Markets Union, and again, they haven't really managed to get too much done, so you could say adding CAVIT is an easy way of getting started.
Saying to the world, look.
Just to get something ticked off. That'd be slightly mean of me saying that, so I'm not saying it. The more relevant answer would probably be that you need, as Christina said, you need something as a benchmark for countries that don't yet have one, and more importantly as well, you need something to defend the actual preferential treatment that CAVITs have within Europe versus the Basel Committee. I mean, we've kind of moved away in many areas from global rules in Europe by implementing whatever LCR rules that are much more advantageous to CAVITs than they are at the Basel level. So you're kind of fighting a defensive fight as well with respect to global supervisors, and setting up some kind of a directive that they can then say, look, we have all of this, but there's a basis for it, and we've even strengthened it in the past few months is probably helpful. And getting, again, back to the sort of benchmarking issue, something in place that can be used for third countries as a tool to sort of identify which ones should actually get the same treatment within Europe as the Europeans do. You're building bridges, you're making allies, you're helping, again, the case of defending the treatment at a global level. So I think
ultimately a good thing. Because over-regulation's gone up on the poll.
Over-regulation. I mean, regulation is not only the European Commission, right? I mean, regulation is a big concept, and I've mentioned the ECB earlier. I mean, that would be for me a clear part of over-regulation. Okay, now it's going down again, but in any case, that to me is kind of the biggest at this point, rather than the European Commission doing what they are doing, because they seem to be doing a rather sensible thing at this point.
Yeah. Okay. Do you agree with that? More in that idea, well, firstly, that they're sort of got to be seen to be doing something, but secondly, actually, in the long term, this is the right thing for the covered bond market, whether or not it needed it. But and this feeds into this idea of keeping the quality of the club together as you get Latin American programs and Eastern European programs. This is the right thing.
Yeah, I think I fully agree. I think to me it's not fix what is broken. To me, it's also a sort of formalization to a large extent of what is already there in a lot of jurisdictions. Not maybe in all level of detail, but it is already there in most of the covered bond jurisdictions. And indeed, if you look at purely the usage requirements, they are quite simple. And I think by moving to a covered bond directive, you get far more detail supporting indeed preferential regulatory treatment. What does concern me, however, is what Florian already he indicated the Basel Committee. What does concern me a little bit, if I look at the current level of detail in the discussion within Europe towards this covered bond directive, then I think that in-depth discussion should really also move more towards the global level, so towards the Basel level. And I hope, yeah, that's essentially also what I hope, that it will also take there the next step. And I think as far as Europe and the European Commission is concerned, that I think that they are very much aware of over-regulation risk.
They are aware of that, Paul. They're aware of over-regulation risk, you think?
I think we are going on the good way, as the panelists mentioned. It's definitely a good way to promote the product and to facilitate investor work. The ECB start this harmonization with the label, and Luca and his team did a lot to have this harmonization in terms of product, in terms of marketing. And what is important, and mentioned the previous panelist, is to keep this flexibility at the domestic level. That means that we will have this regulation, and then we will have some flexibility to adapt the European model at a domestic level. So that means that for the issuer and also for the financial industry and the investor, they will get some different product to meet the investors' demand and to match their need in terms of product, in terms of risk, in terms of maturity or whatever. But one of the main concerns on the covered bond market is, from my point of view right now, of course, the liquidity, and for the bankers and the issuer, we need to provide this liquidity to the investors, and this point is not addressed on the pool. So from my point of view, right now, it is not regulation, because it's a soft way that we are contemplating right now from the European Commission. From my point of view, but there is other question, and definitely we need to provide this liquidity to investors. Yeah.
Thank you very much, Paul. Now, I've actually got some questions from the audience now. The technology has worked. The first one is for the panel, for anyone. What would have happened to the Banco Popular covered bonds if Santander had not come to the rescue? Who would like to take that on? There's a smile spreading across your face. Maureen, would you like to take Anyone care to make a comment, Paul?
We had some example in Europe about a covered bond issuer in some difficulties. We see some in Germany, some in France, and at the end of the day, there is always a solution from the other banks or from the state. So covered bond is a very safe product. Covered bonds are backed by assets. So in a difficult environment for a banking group, there is always a solution, and what we saw in the past, once again in different jurisdictions, is a proof of there is no real risk on the covered bonds product. And Don't forget that we go through the two last financial crises with no default, with no problem.
Not one single default.
Yes, on cover bonds. So
cover bonds, yes.
So that's mean that I'm, at the end of the day, with this collateralized product, I think from an investor point of view, there is no risk. We got some experience on that. Yeah.
Florian.
I mean, it was solved within the BRD, which is sold to someone else. Now, had there not been anyone else buying them, I mean, you would have had
someone else.
I mean, you would have had other tools to sort out the situation, from sort of just wind down of the entity, good bank, bad bank. These type of things would have been on the table with much more severe consequences also for cupboards, which is why I guess Santander in the end, I don't want to say they took a hit, because I guess they managed to sort it out in an advantageous way for themselves.
Yes.
But you could have had, as far as covered bond and covered bond investor risk is concerned, as I said, bad bank type situation or run-off entity type situation, and we have that, for example, in other countries already. Just think of Car Finance, Austrian issuer. Now, after the ECB came out with what they came out with, these bonds lost their repo eligibility. They're out of the framework. So is there any risk to your underlying notional with all the protection mechanisms that are in place? Possibly not. But had there been another solution to Popular, you as an investor could have been in a slightly more difficult situation from a rating angle, from a ECB repo liquidity generation angle, from having to sell when there's really no one willing to take these bonds, because they're also not CBPP3 eligible anymore. So it would have been a bit of a issue.
It would have been a bit of an issue. Maureen, do you agree with that? Would that have been a bit of an issue?
Because I think this Banco Popular example is actually an example where, in quite an efficient way, a solution was found without actually limited spread implications for the rest of the market, and also without a prolonged period of uncertainty of what was going to happen with this particular name. So actually, in terms of that, I think this was quite an efficient solution and good for the bondholders.
Jane, quickly, efficient solution, good for the market. We're all very happy.
Certainly, it was a straightforward solution that chimed with our view of how these things generally play out. We haven't seen any covered bond default, obviously, but we also haven't seen any case where a covered bond has stopped being supported when the issuer has got into trouble. So we haven't seen any cases where a cover pool's been sort of dumped into the vacuum of not having a bank behind it, even if it's a regulatory created bank. So that's very much been the case till now.
Just gave back the banking license. But.
Yeah, so in that sense, you could almost say it hasn't really been tested in terms of purely relying on all the legal features and the underlying assets.
Are we going to?
You could also say it's for a reason, because people know that there's so many assets in there and it's so much security.
Yeah.
That you could say banks and regulators didn't want to test it because they're like, I can better take it over, repay the cover bond, and take back the assets and do something with it instead of waiting and liquidate it in a stress scenario.
I mean, generally, are we going to see any reruns of this? Does the panel think in Europe, will this resolution direction be tested again? Do you think, certainly with a lot of hidden NPLs, that sort of thing in perhaps Italian banks? We've already had one example, but is there going to be more?
Not easy to say, huh? I mean,
okay, let's not predict the future. I've got another question before we end, because we're running out of time. Assuming that the impact of tapering will be most pronounced for lower-rated issuers, does the panel view that those lower-rated issuers are resilient enough to cope with higher funding costs in general in the post-QE era? Would anyone like to take that on?
They will be more exposed.
More exposed.
Because, as currently spreads differences are very small, the ones that are considered more risky potentially or lower rated, they could be exposed more to risk, to rate rises or risk premium rises.
Yes, makes sense.
We talk to strong issuers these days in a number of countries, and they will be bitching and moaning about QE having distorted competition and taking away the advantage they have on a funding cost angle, which is then reflected in them being able to compete for new business. If you take that away, naturally you would have a more selective sort of market. So will they be able to cope? Possibly for a while, yes, because again, it's going to be so damn gradual. But eventually,
had today,
if funding costs are wider for a given issue, they'll either have to compete for more risky business or live with lower margins, and both things aren't exactly ideal if you're an institution. Not going to kill you from one day to the next, but...
Thanks, Ron. Well, we're just about up time. Now, I'm going to do a bit of a quick fire round. I was going to ask you what the biggest threat to the covered bond market was, but something else we discussed, which we haven't had time to discuss properly today, was the danger of the market becoming irrelevant in the face of alternatives. So I might ask you individually, just to, is there a danger that the covered bond market could become irrelevant in the face of alternatives that kind of do the same thing, but are cheaper and easier to issue? Jane?
I find that hard to envisage that happening anytime soon. It's a huge market. It's funding a third of mortgages, something like a third of European mortgages. It would, and the other things that are proposed, things like preferred senior, you don't have collateral. You don't have collateral for that, so that's always going to be, practically always going to be, from our perspective, rated lower, and not really a complete alternative to a covered bond.
So not irrelevant anytime soon?
No.
Absolutely
no,
not.
Absolutely not.
No danger of it, but no sort of sense of smugness.
No, I mean, I think the covered bond product has a proven history of, during crisis periods, of still being able to grant banks access to the market for funding, to still maintain a reasonable level of liquidity. That is also the reason why they have the preferential treatment that they have. And let's not forget, if you talk about senior preferred debt, everybody says, okay, but it's also non-bail-inable. That's not the case. There is a difference between being MREL eligible and being not bail-inable ultimately. Yeah. Plus the fact that covered bonds continue to have a different risk weight treatment. I mean, after the crisis, everybody was regulators were cautious to avoid cross-bank debt holdings. Now you see that return in the LCR language. I mean, senior unsecured debt is nowhere to be found. Covered bonds, banks can hold covered bonds from each other. So I think that there is still a huge difference between a covered bond product and a senior preferred product.
Excellent. Very quickly, Florian.
I had a pretty good covered bond trader before he moved job, but one thing he said was whenever there were people screaming and shouting about AT1s and other things being more attractive, and himself sort of sitting at his desk going, the only thing he said, well, you'll be back, just wait, you'll be back.
You'll be back.
No, definitely no danger. For example, at CFF, we are dealing with this product since more than 160 years with no default. So it's a very robust product and very well designed to refinance local authority business or mortgages in a very good condition. So
definitely not, Barwin.
No, and especially that's why also on the overregulation, I'm a bit surprised about that answer, because in covered bonds in general have always been preferentially treated by regulation.
Yeah, so that's
as long as that's the case, I don't see any threat. No.
Yeah, Christina.
Yeah, no,
Quickly.
I mean it's true. We're seeing a bit of a slow market with volumes 20% down year on year, but we still have to keep in mind we have over 20 different covered bond issuing jurisdictions, over 115 different active issuers in the market, and this will continue. Covered bonds remain a very important long-term funding source to fund mortgages and public sector, and this will continue in the future.
Thank you, Christina. Well, we can all go and have a cup of coffee now. Sorry to keep you. One quick admin thing is, please could you rate this session on your app? Please give generously. And please, a round of applause for our wonderful panel, and thank you very much for all your insights, guys. Thank you very much.